This is very exciting, this mashup.
I love a Money Rehab Mo News mashup.
The
Nicole, this is
first
our
ever, but not the last.
definitely not the last. I have the conversation we just had with Austan Goolsbee, President Austan Goolsbee of the Chicago Fed.
Yes, show
Um,
your deference.
what we're President Goolsbee, once we get into this, but once named the funniest man in Washington, he
Which is a very low bar,
it
by
is
the
a low
way.
bar, right? It is a low bar. We should
But
ask
he
him that.
is hilarious.
He is funny, but it was fascinating, Nicole. He is one of the handful of people on earth who makes the decision when it comes to the Fed interest rate, and he took us inside the room.
Yeah, I thought that was fascinating because it's a place that we don't get access to. We don't get access to the Supreme Court. We don't get access to these super fun FOMC meetings. A girl can only dream. But to be clear, when you called him a president, the way the Fed works is that there are governors and they get to vote on things like interest rates. And then there are rotating bank presidents. The New York Fed bank president always votes because they cover Wall Street. But then the other bank presidents rotate. So right now, Austin is voting in this big meeting that's coming up that's going to decide interest rates, which
Yeah,
everybody cares about.
and he described how you have to like check your cell phone at the door. And then he took us into all of the numbers. You know, he's a self-described data nerd, and he was taking us through the numbers and all the considerations they have as they make this hugely consequential decision when it comes to interest rates, the impact it has on jobs, the economy, productivity, inflation. And so I found that perspective really fascinating, and I hope it translates to the listeners here.
Yeah, I hope nobody falls asleep because this is really important. Can you give the context of why, just as a refresher, BLS matters? What is it? What's the deal with everybody caring now about the Fed? I mean, you and I have covered this for 100,000 years, and not once, not ever do I remember this much interest in all the inner workings of the Fed.
Well, one of the reasons it's gotten so interesting, and it's something we attempted with him, but knew that he wouldn't dive too deep, is that there's a certain individual these days who is particularly interested with what the Fed does. His name is President Trump. He posts on social media about it. He was actually one of the only presidents ever who's actually made the trip down to the Fed recently to be in person with Jay Powell, and he's been very clear that he wants interest rates lowered. So we dove into that. But some of the data that they have to interpret going into this is also something that President Trump has been particularly interested in, which is the jobs number. In fact, he thought the revision was so significant recently that he fired the head of the Bureau of Labor Statistics. So we talk about that, and that's one of the questions I had for Goolsbee here is that, do you trust the numbers that you're getting? The president certainly is critical of it. Others are critical of these revisions. Is there a better way to be doing things? So when it comes to that, and of course, again, the president's interest in the Fed has gotten to the point where recently he has attempted to fire, sort of in limbo right now, but he fired a Fed governor, Lisa Cook. So she'll come up in this podcast. And that's another question we had for President Goolsbee was, what do you make of this? He's firing people. How does what's happening at the White House impact the decisions you guys are making over at the Fed?
Yeah, we didn't ask if we should call him president or doctor. He has a PhD in economics, so
Right.
he is a doctor.
I,
I wonder if he raises his hand on a plane when there is a request
is
for a
there a
doctor.
doctor? Is there a
Should have
doctor
asked.
on the plane? Yes. No. I'm
Dr.
a
Goolsbee.
Dr. Goolsbee, can you assess the condition of the patient? He's like, only if the patient is the nation's economy. I cannot do much for this lady.
He was actually his prognosis overall, I think, was pretty positive. And he really settled in on where he thinks interest rates should go. We'll have to check the internet, but I don't think he's done that yet. But he did it here.
I think you broke some ground there, Nicole. I think that people should listen to this entire episode. Again, I think we have a lot of listeners who are nerds out there. I think
Sure.
the conversation is interesting. I think he keeps it relevant. And he definitely uses a lot of metaphors. We talk about dragons and tunnels and night watch.
We mixed some metaphors and it hurt my literary heart, but generally my economic heart was so glad.
And we all have Chicago
Yours was
connections.
Jewish.
And so
Yeah.
we get into that as well.
It has been such a wild time to be a member of the Fed. Honestly, I can't even remember a time where there's been this much focus on all the players of the Fed. No offense. Can you?
No, not. I mean, it's been highly unusual. Maybe the economy was so unusual. This is one of the strangest 5-year periods, most unprecedented 5-year periods for the economy ever. So maybe that's what makes it weird for the Fed too.
It is pretty weird. I mean, the next Fed meeting is also a really big one, September 16th to 17th. Can you tell us a little bit about what goes on in these meetings? It's one of the few places that we don't get to see inside of. So, can you take us in the room where it happens, so to speak?
Yeah, look, if you're an econ nerd like me, going to the FOMC meeting is just about the coolest thing there is in the world. You go in a huge room, biggest table I've ever seen in my life. We sit around the table. The shades come down so nobody can spy and see what's being said.
Do you
And
have
they
to give up
go,
your devices?
you have to give up your devices. And I was on the Fed for 5 minutes. I'd been there 5 minutes in my very first meeting, and somebody's phone goes off. Like
Oh,
it's begun. They're just like taking the roll. And there's all these formalities at the beginning. Do 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 do. And I was like, what idiot brought their phone in? Do 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 do. And then I realized, oh no,
no.
it's me. It's me. I was like, I'm sorry. I'm sorry. I'm the new guy.
Did you
And
get a
they go
timeout or
around.
did you get in trouble? What happened?
Well, I got in a little trouble, but they could have, nothing had happened yet. So I didn't get in that much trouble. But that never happened again. And they go around the table, and day one is about the state of the economy, and day two is about what should we do with rates. And Jay Powell's going to say, here's what I think about the economy. And then if you're going to walk down and President Musalam, what do you think about the economy? President Goolsbee, what do you think? It's a deliberative body. It's got a formal aspect, and after some time, the transcripts will come out. So if you're really into this sort of thing, you can go read word for word what happens at the meetings. But it's a very important deliberative body, and people are coming. They built the Federal Reserve in the Federal Reserve Act to have independent thought coming from all around the country. And that's why we have these 12 reserve banks sprinkled all around the US. And people come from very different backgrounds and very different perspectives. And it's been pretty great.
I mean, you said Jay Powell. Do you call him Jay Powell?
I call it Jay Powell. Do I call him Jay Powell? I started calling him Mr. Chair, but he insists on Jay. So that's what I call him. In the transcripts, I will say Mr. Chair.
That's very official of
Yeah.
you. But off the record, it's Jay or Jay Powell.
Off the record, it's Jay or Jay Powell. Yeah.
Now, obviously, Austin, we get information so quickly now. Some say these meetings aren't necessarily in line with the speed of information. You guys are sitting around this big, massive table. Banks, investors are setting prices every second. So by the time you guys are meeting, potentially the stuff you're talking about is old news. I assume you guys are looking at some exciting new data that the rest of us don't already know.
I'm sympathetic to that critique. You said some people, but is it you? You may agree with that.
I feel like we're in a time where the speed
Yeah.
of information is light speed, and you
I have
guys might be a little slow.
That's always an issue from central banks and has been from the beginning, that whatever's the speed of the data and whatever's the speed of the economy, that's on a different timetable than the speed of the central bank. But the only place that is an objection, it's not really an objection, it's an observation. The timetable of traders and the stock market and the social media and in the instantaneous, that's not the timetable of the central bank. And you don't want the central bank to be on that timetable, because the most important thing that the central bank's got to do is figure out the through line and be the steady hand. And if you plot the graph, I'm sure you've seen it, of what does the market think the interest rate is going to do? It's up, it's down, it wiggles around, it's crazy, because the business model of a trader is to get the information as instantly as you can and to try to process it as fast as possible. And if you look at the actual rate, it's much smoother. And I think it should be smoother because this steady hand and figure out the long view, that's kind of the job that the central bank has to do. And that's where I do think having a committee of people who are coming from different regions and coming from different backgrounds is actually pretty effective at figuring out a through line in a way that just the straight up instant reaction is maybe not as good.
Will you go in there, Austin, and have a certain idea of what you think needs to happen and then be convinced by the arguments of the other? Is there like a real robust debate that
Sometimes,
happens there?
sometimes it's not. In high school and college, I was a big debater, and I used to debate Ted Cruz when he was in college. It's not a debate like that. It's more each person giving their thoughts, and there is a robust debate that kind of takes place across meetings. So we'll come in and each person will speak their piece. And then we each bring a plus one research director or something, and they will write down what everyone said. And then we'll come back. And as a group at the Chicago Fed, we'll try to process here were the arguments made by the others. Do we agree with that or not agree with that? What should we be on the lookout for in the data coming up? So, one of the issues coming into September, as you know, is have we defeated the inflation dragon, or is it still under there potentially coming back? And these issues like, well, there's been less inflation on goods than you might have thought from tariffs, but now maybe the inflation is rising on services. Thoughts like that might come up in the discussion, and then we'll come back and be like, here's what we're going to look out for. And then at the next meeting, we kind of have that debate. So I'd say it's robust, but it's not like a, how do you answer, Moshe, to what Nicole just said? It's not like that.
The core debate I know that's been there for a bit now is you referred to the inflation dragon. There's also the jobs dragon.
Yes.
There is the growth dragon. I don't know how many dragons you guys have.
Dragons.
There's a lot of dragons, and the solution for one dragon is different than the solution for the other.
That's the worst. That's the evil. But isn't it like Wizard of Oz? There's good witches and bad witches. The same is true for dragons.
And so then you got the stagflation dragon, which is a combination of a couple dragons, right? And so curious as you go into the meeting right now, is it more an art than a science? Is there one that you're more worried about than the other? How do you weigh both of them, given the ramifications here, both domestically and for the global markets?
This is the hardest part of the job. This is exactly what the central banks is grappling with, and you've highlighted multiple dimensions on what makes the job is simple to understand and not simple to carry out, and that is the law. The Federal Reserve Act says that when setting monetary policy, we're supposed to follow what we've called the dual mandate, which is maximize employment and stabilize prices, which the Fed has interpreted stabilize prices means get the inflation rate to 2% and keep it there. And in normal times, normal business cycle times, there are booms and busts. And when you're in booms and the economy tends toward overheating, that tends to push up the inflation rate, and unemployment will be very low when inflation is high. And when you're experiencing recession, unemployment will be high and inflation will be low. And we developed, not just in the United States, but all central banks kind of developed an arsenal of tools, tighten or loosen the screw of interest rates to offset what's happening in the overall economy. Things get interesting when stuff starts going wrong simultaneously on both sides, or you start getting shocks that are unprecedented and things don't look like a normal business cycle. And that, of course, is what happened in 2020, in 21, in 22. We're getting pandemics, supply chain shortages, a huge escalation of inflation that drives everyone crazy, then the hottest job market, tightest job market we've ever experienced. And so we're slowly working through and trying to answer the question, are we back to normal? There's a town in Illinois, as you know, Normal, Illinois. Have we gotten back to normal? normal's a twin city with Bloomington. So as I phrase it, it's like, are we back to normal? Or are we still in Bloomington? That's kind of the
The
key
home of Illinois
question.
State University.
That's right.
Yeah.
That's right. Good
Uh,
for you,
uh,
Mosh. I'm
Listen,
proud of
as
you.
a Chicago
That's right.
born and raised Illinoisan, I take a lot of pride in the land of Lincoln. A lot of fun facts. We could do a separate trivia hour, Austin, on Illinois.
Oh, I'm
Okay.
in.
But back to the topic at hand here. All of what we've discussed here, Austin,
Yeah.
comes against the backdrop of a president who has taken on, you could say, a historic interest in what the Fed is doing, but also is historically vocal in what the Fed is doing. I imagine you've been watching all the various headlines. First, I want to ask you about one of the people who's going to be at that Fed meeting, Lisa Cook, presumably, what's been going on there, the firing, and what you make and how you handle your job given the interest and the way that President Trump has been trying to push you guys in a certain direction.
I mean, I've been at the Fed for almost 3 years. I was a research economist at University of Chicago for 30 years before I got to the Fed. I was always a firm believer, as virtually every economist unanimously is, in the importance of Fed independence, that a central bank needs to be independent from political interference, or else inflation is coming back, growth is going to be slower, the unemployment rate is going to be higher. Just look around the world at places where they do not have Fed independence. It's a mess. And that includes countries where they had it and then they got rid of it. And it's kind of like the day they announce there's not Fed independence, all hell starts to break loose. So it worries me, having nothing to do with partisan whatever. You become a sworn member of the Federal Reserve, you're out of the elections business. But it's important that we remember that Fed independence is critical. The reason why the governors are appointed to 14-year non-overlapping terms, and that the reason there are 12 Federal Reserve Bank presidents who are not political appointees, they are chosen by local boards of business people and civic leaders to represent their region. And the chair is not on the presidential cycle. All of these things tell you that when they created the Federal Reserve, as today, people were deeply uncomfortable with Washington, D.C., plus Wall Street from controlling the whole U.S. financial system or setting interest rate policies with things in mind other than the dual mandate. What should drive interest rate policy should be the economy. And what are the prospects for maximizing employment and stabilizing prices? All of that's the long backdrop to say, I'm just trying to do my job as best I can to represent this region in the Midwest. And I base all of my decisions about the interest rate and monetary policy on the state of the economy and the economic outlook. And my experience with everyone around that table, whether they were appointed by Democrats, Republicans, or are non-political appointees like me, they take that job very seriously. And I think I think whoever comes on, it changes, the composition of the committee changes, but I would be very surprised if, as people become sworn members of Federal Reserve, they don't take the job real seriously.
Are you worried about the rhetoric, or are you saying here that the members of the Fed, you guys have blinders on, and no matter what is true socialed out or tweeted out or announced by the president has no effect on your decisions?
You didn't know, but the way you asked the question would get me in trouble to answer, which is nobody on the FOMC is allowed to speak for the committee or for anybody else on the committee. They can only speak for themselves.
Got it.
I like to think that I'm the most omnivorous data consumer that is on there, but I'm one member of what I call the Data Dog Caucus. And that's anybody who's not on the committee can have any opinion they want. And I try to pay attention to the opinions of informed people and what their arguments are about where we are in the state of the economy. But the only thing. And you can read the minutes yourself and you'll get the transcript and you can read word for word what's on people's mind. You're going to see what's on their mind is not elections and politics. What's on their mind is what's the state of the economy, what's happening to growth, employment, inflation, et cetera.
So you, Austin, one man, are not concerned that the president says he's seeking a majority on the Fed's board? What do you make of that with this implication that he thinks the votes to roll?
I'm not a pundit. I know that as I say, the composition of the committee changes over time. We have a structure that's as insulated from politics and political interference as is possible. And I just reiterate, it's crucially important. The Secretary of the Treasury, Bessent himself, said he wants the Fed to remain independent, and economists are unanimous. The Fed must be independent. If it's not, inflation is coming back.
Well, Ray Dalio, who was just on the show, recently said that with huge budget deficits, and I'd love to make the linkage in just a second, a strong independent Fed was hugely important. I mean, don't you love being in agreement with Ray?
I do like being in agreement with Ray. We don't comment on fiscal policy, but I will say that the canonical test case, definitional, why is Fed independence important? It is precisely so that in the kind of would you call it an arms race in the economic literature, if you have a heavy fiscal expansion, you want to be able to convey to the world that that political monetize the debt argument will not carry the day in the central bank. If it does, that's why inflation comes back and long interest rates go up and a bunch of things start to go wrong in an economy. And this is not just a theoretical. There are countries that did this. And if you go look in countries where they do this, it often ends very badly. And we should not be going there.
Well, that I think is what Ray is talking about. That's what we're saying. If short end of the curve goes down, it floods the market with liquidity, increases government spending. So eventually that trickles out to the long end of the curve. And that's what Ray has been worried about for a very long time. Do you think that hurts the government when it comes to financing our national debt if it becomes that much more expensive? I mean, how worried are you, or how worried should we be about the debt?
As I say, it's not my place on the monetary policy side to tell Congress or the president or whoever what tax policies they should set, what fiscal policies they're going to set. You've seen Chair Powell say at press conferences, and you just go pick up the CBO report, you know that the long-run fiscal position of the United States, while being better than most rich countries, is not fiscally the debt to GDP ratio. It continues to rise. We're not at some stabilized debt to GDP ratio. My own thinking is that is not that sounds close to the monetizing the debt argument to say, well, should the Fed change the interest rate to make the debt less costly and make it easier to run debt? That is the fiscal dominance, monetize the debt type argument. That's not in my head. That's not how I think about it. I can't speak for the committee, but I think it's important, in my mind, for a central bank not to think that way, that we're going to go off of what the conditions are. We're not trying to make it easier or harder for them to make their decisions.
So when we were talking about the dragons earlier, the debt dragon is not one that you're trying to fight.
The debt dragon, that's not our job to fight the debt dragon. That's, look, straight up fiscal policy, and the president and Congress and the American people got to decide what they want to do. I always say, look, you know, you're an Illinois guy. There is no bad weather. There's only bad clothing. And so you tell us the conditions, and then our job is to figure out the jacket. And the fiscal policy are the conditions on this one.
Well, listen, I'm an LA lady who went to Northwestern, and so I figured out that I needed to buy socks for the first time when I was 17 years old. But speaking of all that data, Commerce just announced that they were putting GDP on public blockchains. I mean, should that be the rule and not the exception? Is there a better way to get this data that you cite?
I heard that, but I don't exactly know what that means. You're never going to hear me say throw some data away or pay no attention to it. I'm an absolute omnivore of data. I'll take whatever you got because getting more data helps you figure out the through line, my view. To the extent that everybody, private sector and public sector official data have gotten noisier because people don't respond to surveys as much, things on the internet that just have a lot more noise. One worldview says, oh, therefore we should throw it away or pay no attention. In a world where every data series got noisier, I want more series, not fewer series. Putting the data on the blockchain, if that connotes we need more real-time measures, I basically agree. I love the real-time measures. Before I was ever at the Fed, I was involved with a friend of mine who teaches at Stanford, Pete Clino. He and I helped Adobe create this online CPI called the Digital Price Index, and it tracks online inflation. And you can do it daily. You could do it minutely if you wanted, and at a granular level of detail. I find the new data sources really exciting and far noisier than the official numbers are. So I think people want to be a little careful if they go the extra step and say, well, if we put something on the blockchain, then maybe we don't need the unemployment rate anymore, or maybe that we don't need to do the first revision. I think that's dangerous because if you start peeling back the layers, almost all the private sector data to be in the realm of less noisy rely on calibrating with the official data.
Talking data, there's been a lot of talk of late about the BLS number, the jobs numbers, the controversy around that, the revisions.
Yep.
As somebody who takes in all the data, do you think there should be a new approach to how that data is either taken in or released, given, how the survey's been put out, the response rate keeps getting worse? How do you take in the BLS data, and how do you think it needs to be potentially, the system needs to be revised in the year 2025?
All of those are really important down in my world, in the grubby world of we're getting monthly numbers and how do we figure out what do they say about the economy? I'm completely open. I was on the Census Advisory Commission for 6 years and have thought a lot about public data. The first thing to note is the public data have gotten noisier. The revisions have gotten bigger because it's noisier. And it's still the best data that exist. It's the best in the world. It's the best data that we have. It's better than anything in the private sector. That doesn't mean it's perfect, and we should totally be open to how do we improve it? How do we supplement it with private sector sources? So I'm totally open to that. That's different from should we get rid of it because there are revisions? Absolutely, we should not. And the way personally I think about it, like as we go into the next FOMC meeting, I put a little bit more grain of salt in evaluating, especially headline payroll job creation numbers like the one that's been having the revisions, when you're living through a period where there are major immigration changes happening that are unobserved. We saw the other way in 2024 when we had a bunch of immigration coming in that we hadn't been tracking. The monthly jobs numbers were surprisingly high. We're getting 150, 180,000 a month. And there were some people saying, that's a sign the economy's overheating. How could you generate so many jobs in a month without generating some inflationary pressure? And the answer was, Well, because actually the population was getting bigger in a way you didn't know. And if you're going through a period where now immigration's going the other way, just be a little careful over indexing on a monthly aggregate number. I I usually say what we found last year is that things that are rates are better than things that are raw numbers. And so the four horsemen of truth and justice, as I say, from the job market were the hiring rate, the layoff rate, the vacancy rate, and the unemployment rate. Those four gave you a better indication of what's happening in the labor market in terms of business cycle than just the monthly raw jobs created number did. And so the short answer to your question is what I do when you get some more noise in the official data is not throw away the official data, is just go get some more measures and try to get a broader sense of where the job market is.
So let's go back to the room where it happens, so to speak. And how do you synthesize all of this? Should we all feel optimistic about rate cuts? I know you
You
allegedly
snuck it in. You snuck it in there in the back half.
totally. I know you can't say much. Poly Market does
Yeah.
have 25 basis points down in the next meeting. It's at 82% right now. So a lot of people are feeling pretty positive and optimistic. Would you agree with that?
Well, look at the two parts of your question. One was, how do you process all of this? And then the second was, and what does that mean? Where's your head at? How we process this is every bank, and especially at Chicago, we have one of the biggest and most respected research departments of all the feds. And we'll spend a solid week or week and a half preparing for the FOMC meeting with all the latest data as well as what the trends were. Where does that put me in my head? I don't like tying our hands before the meetings when we've got important data that are coming down the pipe and before I've heard what any of my colleagues have had to say. That said, I would describe before April 2nd, before we got the what I consider the dirt in the air episode of tariffs complicating things, I thought we're pretty much stable, full employment. Inflation was a little above the target, but coming down, and I could see a pretty clear path that it's heading to 2%. And so I thought it made sense for rates to move down to something like where they're going to settle, that the short rates would go down a fair amount from where they are now or from where they have been. And that the problem from April forward is if you start doing things like tariffs that are going to potentially increase the inflation rate, at the same time, they're going to make growth slower and make employment look worse. Now you're putting the central bank in the toughest position there is, which is both sides start going wrong at the same time. You got to balance out, well, how long do you think each side is going to last and which one is worse and stuff like that. And I feel like we're still sort of in that space. And if we could just get this dirt out of the air, I think underneath all of that, it still basically looks like what it was pre-April 2nd, which is a strong economy where inflation was trending downward. And in that, the more it looks like that, the more comfortable I am saying again, I think rates should go down a fair amount to something like where they're going to settle. And the thing that made me nervous, we're getting a little bit of cross currents in the data. Overall inflation was pretty modest for 2-3 months, giving me some comfort. Hey, maybe the tariffs at the end of the day, imported goods are only 11% of GDP. So maybe we're going to work through this thing and it won't be that big of a deal. The last inflation readings we've gotten show services inflation starting to kick up. Now, I hope that's a blip. If that's not a blip, that's more worrisome because that's probably not coming from tariffs. And if the inflation dragon comes back, the central bank has to fight the inflation dragon. There's some people who say that's the only dragon it should be fighting, but everybody agrees that the Fed has to stop inflation from going back.
It's just really quick to double click on what you think what does fair mean? Can you quantify that?
Fair, did
And
I say
where should it
fair?
settle? Yeah.
Oh, a fair amount.
A fair amount, yeah. What
Look,
does that mean?
here's loosely in my head. I'm not going to commit to exact number, but as you know, the entire FOMC puts out the dot plot each quarter. And in that, they ask them, what do you think will be the appropriate rate at the end of this year, at the end of next year? And they ask, in steady state, what's the long run rate? And I think the median of those dots is somewhere like 3 or 3.25. That seems like a perfectly reasonable starting point to me. And to me, that's a fair bit below where we are today. If we're 4.25 to 4.5, there's a long way to go before we're to where I think of it as, in our language, neutral, like where the short rates would go. But we just got to get out of this period. Are the critics really saying that if inflation, the new months of inflation are coming in at 3 or even 4 or 5% annualized inflation rates, that the Fed should be cutting? I mean, we're in a difficult circumstance if we're facing that kind of a situation.
How far into the tariff tunnel are we when you look at the data? I mean, do you need to get to the end of the year? Do you need to get to next year? I mean, given that tariffs aren't going, it appears.
I hope not. I mean, where we're in the tariff tunnel, I'm thrown because Nicole, and my last answer, she had a look on her face of like, I don't know. You didn't seem persuaded.
I'm persuaded. It sounds like what you've said is that we need at least a percentage down, and we're inching toward that, and likely gonna have
we're inching toward it. And like when we just,
meeting.
if you got some dust out of the air, that's sort of the path that I was thinking in my mind in this pre-tariff period. And just like convince me we're most of the way through the tariff tunnel, and I'm still feeling okay on these paths. Now, Mosheh's tariff tunnel, that's probably the right way to think about it. And how long is the tunnel? There's two questions. How much will tariffs raise inflation? And then the tunnel question, how long will it last? So in the theory, just like Econ 101 theory of tariffs, a tariff's a one-time increase in the price, but it's a transitory impact on inflation. Because if you put in a 10% tariff, you get the 10% of inflation right away, and then there's no more inflation. People will still be upset. And you saw that from the inflation we had. And then as inflation came down, people said, well, I don't care if inflation is heading toward 2%. The prices are 15, 20% higher than they were before you started. So people will still be upset. But the central bank, in the theory of a one and done tariff, in a way should kind of look through it, because that's not going to last. The only problem is this one's not one and it's not done. To the extent that we're going to keep coming back and saying, okay, well, now we're going to put 50% on India, 50% on semiconductors. We're going to apply it to costs of production and parts and supplies so that it's no longer just on imported goods, but now it's going to increase the cost of domestic production. Out in the 7th district, where we're the most manufacturing intensive, as you might imagine, I got an earful from our businesses about that kind of tariff's going to wipe us out. To the extent that we're signing deals and getting the rates down, or we don't enact these, or the court cases come in and they say, no, you can't have tariffs that high, then I'm feeling more comfortable. We're back to where we were, and it'll be okay. If there's not an inflationary impact or a significant inflationary impact of tariffs, then why do we care? In some sense, tariffs are just one other thing that changes in the background, like economic conditions, like the productivity growth rate, like anything.
Well, the president said that we would be a third world country without them, but it sounds like that's not what you're seeing.
Look, as I say, I got out of the elections business. If Congress or the president want to pass tariffs in their wisdom, they can do that. My job is just if something affects inflation and drives up prices, the law says the Fed has to think about it.
Is there, you take in all this data, and as you look into this upcoming meeting and future meetings, is there one thing that has you worried at night, that has you up at night, Austan? Is there a certain number or statistic that is your North Star?
I often say that the job of central bank is we're the night's watch. Our job is not to sleep at night. There shouldn't be anything that goes wrong that we haven't at least thought through. What will we do if XYZ happened? Now, that said, the number that I think about a lot, that's the most, for sure, is the least talked about, most important number, is the productivity growth rate of the economy, which is output per hour, output per worker. It's mostly driven by technology. The last 2 years, it's been outstanding, growing faster than the trend of the last 20, 30 years. And when productivity growth is high, that's like what happened in the late 90s. It's wonderful for the economy. Wages can grow faster than inflation. They determine how fast the economy grows, and they relieve the constraints on the central bank. If the productivity growth rate slows down, and there's a lot of research evidence that tariffs, for example, by increasing the cost of production, could have a negative impact on productivity growth, or if you scale back investments in science and R&D and those kinds of things in a way that scales down the productivity growth rate, then all of the glorious thing that I just described starts going the other way. Now wages can't grow. The real wage can't grow very much. There's a higher risk of inflation for any given growth rate. So that's a noisy series on a month-to-month basis, but it's critically super important on a longer run basis.
Well, Austan, you are our favorite nerd, funniest guy in Washington. Thank you.
That is a really high compliment.
Come
Now,
back
do you
anytime.
want something you can take to the bank? I thought you want to take something to the bank.
Oh,
That sounds
you
like-
listen to the show.
Yeah, of course I went.
Yay,
Yes, and we take it to the
Austan.
bank.
You're such a good money rehabber. We end our episodes with the tip listeners can take straight to the bank.
If I had one of that people can take to the bank, it's just remember that when people talk about interest rates, there's not one interest rate. Okay, there's short rates. They influence things like credit card rates and stuff like that. And that's what the Fed sets. And then there's long rates, which influence mortgages and treasuries and things of that nature. And the Fed doesn't set those. And so they can go different ways. So if you're an investor, let's say, and you're thinking about, if the Fed's going to cut rates, what's going to happen to bonds? It makes a big difference. What kind of bonds are you talking about? And take that to the bank and remember it.
Yeah. All right. So if mortgage rates are up, don't be mad at you.
Don't be mad at me. I didn't do it. Yeah,
Your fault.
exactly right. Thank you. Thank you. That's exactly right.